Imagine waking up one morning with three envelopes on your kitchen table. One says your money, another says your mind, and the last says your future. You open the first, and it's a mix of bills, small savings, and a plan that used to make sense. You open the second, and it's full of memories, worries, habits, and quiet hopes. You open the third, and it's mostly blank, but not empty. It's waiting for choices. If you're over 60, those three envelopes are not abstract metaphors. They are the daily reality that shapes whether your next decade is secure, meaningful, and free. This video is about why that trio matters, psychologically and economically, and about the practical bridge between them. Most conversations for people 60 plus focus on one envelope: saving more, spending less, or finding a hobby. What rarely gets talked about is the way the mind steers your money and how your financial choices rewrite the story of your future. We're going to map how emotions, habits, and cognitive biases interact with retirement incomes, health costs, and the desire for purpose. We'll also give science-based ways to change those patterns, practical steps you can use this week. Let me start with a short story. Martha, 67, worked in a school for 40 years. She had a modest pension and a little nest egg. After her husband died, she stopped financial mail because it felt like paperwork from a different life. Small bills piled up. She got frustrated and paid unnecessary late fees. When a bank sent a low-rate reverse mortgage letter, the loneliness and fear of running out of money nudged her to sign, until her niece intervened and helped her map alternatives. That sign, the choice to act or avoid, is where the mind meets money and shapes the future. Martha's story is common because the decisions we make after 60 are driven by mental patterns formed over a lifetime, and small nudges can either protect or erode a lifetime of work. Over the next 5 parts, we'll unpack the psychological landscape of agging and financial choice, the real financial principles that matter now, concrete, actionable steps you can take, and the mindset shifts that turn anxiety into agency. This is not about scaring you into frugality, nor is it about selling a one-size-fits-all plan. It's about honest, practical tools, cognitive strategies, and financial moves that converge to protect your money, calm your mind, and free up your future. Stay with me. This is the guide nobody talks about, but everyone over 60 deserves. Insight 1: Loss aversion and the weight of past losses. Humans are wired to feel losses more strongly than equivalent gains. Psychologists call this loss aversion. After 60, the prospect of losing money or health often triggers decisions driven by fear rather than reason. That fear can push people into defensive, financial moves, hoarding cash under the mattress, avoiding investments entirely, or accepting poor deals to avoid perceived risk. Yet the same aversion can blind us to slow erosion. Small fees, inflation, and missed income opportunities compound. Recognizing loss aversion means naming the feeling when it appears and asking whether the choice is protecting you from a real risk or from an imagined one. Insight 2: Status bias, sticking with the familiar. As we age, the comfort of routine grows stronger. Change feels riskier than it once did. Status bias leads many retirees to keep old financial arrangements, outdated bank accounts, insurance they no longer need, or investments that no longer match their goals, because changing requires effort and emotional. This bias helps explain why someone might stick with a high-fee mutual fund simply because switching feels like admitting a past mistake. The cost here isn't dramatic at a glance, but it accumulates. Fees, lost returns, and missed tax efficiencies erode long-term security. The antidote begins with small, low-stakes changes that build confidence and break the inertia. Insight 3: Cognitive load and decision fatigue. Managing finances involves many small decisions: how to pay a bill, whether to call for a quote, whether to consolidate accounts. For older adults juggling health concerns, caregiving responsibilities, and social changes, this cognitive load can create decision fatigue. As choices mount, people are more likely to default to the easiest option, often the most expensive or least optimal. Decision fatigue also lowers the capacity to learn new tools, like online banking or brokerage platforms, which further narrows options. Reducing cognitive load by simplifying accounts and automating routine payments can free mental bandwidth for the important, higher-level choices. Insight 4: Identity and money narratives. Money is more than numbers. It's part of identity. Someone who defines themselves as a provider may equate spending with loss of purpose. Others who associated self-worth with thrift feel anxious about spending on care or travel. These narratives can block healthy financial choices, such as investing in needed home adaptations or taking a modest risk that improves well-being. Challenging those stories, reframing spending as investment in quality of life or purpose, changes the calculus. Therapy, peer conversations, or financial coaching can help rewrite harmful narratives into ones that support both security and meaning. Insight 5: Social influence and financial isolation. Peer groups and family shape. Older adults often make financial decisions in the shadow of friends or relatives. When a neighbor buys a new car, when siblings pressure for inheritance arrangements, or when adult children push for conservative choices. Financial advice from peers is well-intended, but may not fit one's unique situation. Conversely, social isolation can leave one without a sounding board, increasing vulnerability to scams or missteps. Strengthening honest financial conversations with trusted people, professionals, a child who understands the basics, or a community group, reduces the risk of poor choices driven by social pressure or loneliness. Principle 1: The power of longevity risk and sequencing. One of the central financial realities after 60 is longevity risk, the risk of outliving your assets. This changes the math. A retirement strategy must account not only for current needs, but for the possibility of living 20-30 more years. Equally important is sequencing risk. The order of returns matters. Suffering large portfolio losses early in retirement can drastically impair long-term sustainability, because withdrawals during downturns force selling at low prices and reduce the capital base. The practical corollary is to design a portfolio and withdrawal plan that balances growth and protection, a mix of stable income, liquid reserves for the near term, and growth assets to outpace inflation over time. Principle 2: The role of guaranteed income versus flexibility. Guaranteed income, pensions, annuities, or social security provides a psychological and financial floor. It reduces the need to sell assets during downturns and covers essential monthly needs. But guaranteed income often trades flexibility for certainty. Some annuities are illiquid or offer poor legacy value. The ideal approach uses guaranteed income to cover essentials, while retaining flexible assets for discretionary spending, healthcare surprises, and legacy goals. The balance depends on individual risk tolerance, health expectations, and family needs. The key is explicit design rather than blind acceptance of one option. Principle 3: Inflation and the erosion of purchasing power. Money today will buy less in 20 years because of inflation. For people on fixed incomes, modest inflation is particularly erosive because expenses like healthcare often rise than headline inflation. A strategy that relies solely on cash or very conservative bonds may feel safe yet steadily loses purchasing power. Therefore, a portion of assets should remain exposed to growth strategies, equities, inflation-protected securities, or real assets to preserve real value. The amount depends on risk tolerance and time horizon, but inflation is a common and costly mistake. Principle 4: Fees, taxes, and small drains that compound. Tiny fees and tax inefficiencies are quiet wealth killers. High management fees, unnecessary account types, or failing to optimize tax strategies, conversions, tax loss harvesting, or timing withdrawals shave returns. Over decades, these small drains compound into meaningful lost income. Effective financial design includes fee awareness and tax planning that align with retirement goals. Negotiating lower fees, moving to index funds, or seeking tax-advantaged withdrawals can create surprisingly large benefits without increasing market risk. Principle 5: Liquidity planning and emergency reserves. Retirement planning isn't just about portfolio returns, it's about liquidity. Unexpected medical bills, home repairs, or family needs require accessible funds. Tying everything up in illiquid vehicles or assuming you can sell at a fair price in a crisis is risky. A layered liquidity plan, a short-term cash buffer, a medium-term reserve in conservative instruments, and long-term growth assets smooths withdrawals and protects against being forced into bad timing. Good liquidity planning reduces stress and keeps long-term strategies intact. Create a 3-envelope financial map: essentials, stability, opportunity. Start by dividing assets mentally and practically into 3 envelopes: essentials, guaranteed income and short-term cash; stability, low volatility, bond-like assets and emergency reserves; and opportunity, growth assets and discretionary funds. This structure translates psychological comfort into economic design. Essentials remove the fear of running out; stability reduces sequencing risk; and opportunity allows your money to keep pace with inflation. Implemented by listing monthly essential expenses and matching guaranteed income streams to them. Then set a 1-3-year cash reserve for surprises and allocate the rest to growth within risk limits. Revisit the map annually or after major life events so the envelopes remain relevant and reflect health changes, family needs, or market shifts. Reduce cognitive load. Automate, simplify, and delegate. Reduce decision fatigue by automating routine payments, consolidating accounts where sensible, and creating straightforward rules for small decisions. Automation prevents late fees, missed contributions, and the mental friction that leads to avoidance. If technology is a barrier, ask a trusted family member or a certified fiduciary to set up read-only access or payment arrangements with clear boundaries and oversight to prevent abuse. Delegation doesn't mean losing control. Document passwords, create a power of attorney for health and finance, and schedule periodic reviews. The psychological benefit is immense. Less daily stress, clearer focus on strategic choices, and more bandwidth to enjoy life. Reframe spending as investment in well-being. Challenge the instinct to see every spend as loss. Some expenditures, home modifications for aging in place, preventative health care, social activities that reduce isolation, yield returns in quality of life and often reduce future costs. Before cutting discretionary spending reflexively, assess the long-term value. Will this expense reduce future health risks, improve independence, or enhance mental health? Create a prioritized list of well-being investments and treat them as part of your budget, not indulgences. Psychologically, reframing helps align identity. You deserve security and joy with financial reality. Some spending protects future finances. Implement a withdrawal strategy that reduces sequence risk. Adopt a structured withdrawal plan, such as the bucket approach, short, medium, long-term buckets, or a blended rule combining a safe withdrawal rate with dynamic adjustments for market performance. The bucket approach uses cash for near-term needs, bonds for intermediate, and equities for long-term growth. You only sell from the appropriate bucket, reducing the need to liquidate growth assets in downturns. Alternatively, consider flexible withdrawal rules that cut discretionary withdrawals during bad years and allow catch-up in good years. Work with a financial planner to model scenarios. Even simple Monte Carlo projections or stress tests can reveal vulnerabilities and suggest adjustments. Protect, but don't over-insure. Smart use of guarantees and legacy planning. Insurance and guarantees have a place. Long-term care riders, appropriate health coverage, and a calibrated use of annuities can provide protection against catastrophic costs and longevity risk. However, overbuying products with high costs that offer questionable value can reduce liquidity and legacy potential. Assess the worst-case scenarios. Can you or family absorb certain costs? If not, a partial or targeted insurance product might make sense. Also, clarify estate plans, beneficiaries, and records to prevent unnecessary legal costs and family conflict. The economic benefit is protection. The psychological benefit is peace of mind, but both require deliberate, informed choices rather than reactive purchases. Summarize key takeaways in actionable mindset terms. Protect, simplify, grow, and enjoy. Protect means the financial floor, guaranteed income and emergency reserves, so that daily life isn't driven by fear. Simplify means reducing cognitive load and unnecessary friction so decisions feel manageable and are more likely to be good ones. Grow means allocating part of your assets to counteract inflation and maintain purchasing power, not to chase high returns, but to preserve real value. Enjoy means reframing certain spending as valuable investments in health, relationships, and experience. Embrace the mindset of curious stewardship. Rather than seeing your money as a fortress to be perpetually defended, see it as a set of tools under your stewardship. You decide which tools maintain safety, which tools deliver comfort, and which ones generate future opportunity. Curiosity opens you to learning small, high-impact changes, understanding one fee, attempting one automatic payment, talking to one trusted advisor, and stewardship helps you preserve dignity and purpose. This shift reduces the twin traps of paralysis and impulsiveness. Finally, remember that psychological resilience can be learned at any age. If fear, grief, or habit is steering your finances, you can retrain responses with small experiments. Delay a decision for 48 hours, ask a trusted friend to review an offer, or set up an automatic transfer that aligns with a priority. These experiments create evidence. You'll learn what helps and what doesn't. Over time, small wins compound into confidence, healthier financial choices, and a richer future. Closing lines, call to action and reassurance. If you take one thing from this guide, let it be this. Your mind and your money are not separate silos. They are partners in shaping your future. Protect the essentials, simplify the everyday, grow to keep pace with time, and spend on things that nourish your life. You don't need to be perfect. You need a map and a few deliberate moves. Open the envelopes on your own terms. Name what matters, design the guardrails, and let the rest support a future that's secure and meaningful. If you found this useful, consider saving this script, it with someone you trust, and starting one small change this week. Your future isn't just about numbers, it's about the life those numbers make possible.